Hi everyone, this is the 7th of Feb 2020 and I wanted to do a quick bite simply on what happened yesterday. So following the budget, which a lot of people thought was bad, or even though they actually pushed the fiscal deficit numbers slightly on the upside, probably the main thing the markets were looking for was more direct impact in the form of maybe LTCG or other things. But the point here is, moment that happened, my first thought was then that means the RBI has to do something. And now the whole street was not really expecting a rate cut, and that kept me thinking as to how would they really do something, because nobody's really expecting it. And I thought that probably if the government has not gone all out on spending, even though they've raised the bar, probably they've left some room for the RBI to act, and they actually did yesterday. I think in the video itself, in my video yesterday, I did not cover it, but what we have seen in the final print, and when you actually listen to the entire discussion later on, is that they've taken measures not just on the real estate side, but to also lower the CRR rate for particular loans. Now, it's a certain amount of stimulus, may not be huge, but at the same time, it's liquidity. So the whole thing that I was speaking about for the last couple of months on the bullish side of the market was that you're getting liquidity from not just the international markets but also the domestic market, and slowly you're moving towards some kind of fiscal intervention. So you got a bit of that, but you're also still getting monetary stimulus, which is why bond yields fell yesterday. They also a little lower today morning, and that is having a direct impact in terms of how markets are behaving. So markets are still responding to a lot of liquidity, apart from the growth rebounds. I mean, it's not enough to say it's rebounded. There are only minor data points. You cannot say that one data point in a particular month is a complete reversal. So liquidity still remains the elephant in the room, and that has been true around the world markets. I mean, US has been pumping it in through the repo markets. China, after the virus attacks, recently announced $500 billion worth of intervention, and so on and so forth. And that remains a primary driver, and I think will remain also for the rest of the coming year. So that's what I wanted to highlight, because on Twitter there was there's a question that kept coming up from one of the followers, and he was countering this, that this is not good for the long term, and there's no real doubt about that. I mean, we know that we are in an economic winter. I have not really changed that thesis. That thesis started with me in 2009, and if you bought any companies that had high levels of debt, and this was late 2009, so just at the start of 2010, anything that you invested in that had high debt back then, all of those stocks really did badly on a 7 to 8 year basis. In fact, some of them are even wiped out, which is like you see in the prices of the ADAG group and many others. Some of them responded later on when you actually came to know the size of the loss in a particular financial entity, whether it was ILFS or whether it's Yes Bank, which is still surviving around. It's only the private banks that were only lending to the top end that managed to get through this. So this is what has already played out. So it played out over a long period of time and not all immediately. And you would have thought that eventually such a big wipeout would have an impact on the market in terms of indices, and the only reason it has not done so is that single word, which goes back to liquidity. And we've provided this in many different ways over the years, whether it was through OMOs, raising salaries and so on. And so when you look at it from that front, what it was really about was kicking off spending. Now, what does that mean? You've encouraged spending in consumerism, even through borrowing, which means take loans and spend, and which is why you get so many SMSs, messages and emails about personal loans and so on. And that entire segment is what has driven. So consumption has really been the driver of the last several years, and consumption is always the theme in an economic autumn which precedes a winter. Now the funny thing is, though I started writing about the winter, a lot of the things this in India specifically, we're seeing both of these things happen simultaneously. Otherwise, typically you go through an autumn, when you study history, you go through an autumn bull market, and then that peaks on excessive spending, and then the deflation after that really corrects it. And right now, because you had some excesses from early on and you've continued to provide liquidity, you are simultaneously getting these two things happening, which is the winter effect from bad loans, and at the same time a spending boom, which is what you get in an economic autumn. But the economic autumn boom always ends in overvalued asset prices. So some people may say we are overvalued today, if not at a market level, then in certain sectors. But how long does this go on? So The point is we have to track markets and let them move and be with them as long as they go. If liquidity is the driving factor, that's just how you have to allocate your assets and be invested in the right places. At the same time, knowing that at some point of time this can turn the other way, and you need to put in place a model or certain tools to tell you when that is happening and move out of the way. Now, people who believe that you can never move out of the way, I don't really completely agree. You can move out and you can move in. The question is, how fast have you trained your mind to be able to move from one thought process to another and back if you have to? And that's where the failure occurs. It's in the decision making process and the ability to take decisions rather than having an opinion on something. So, but people like to put it that, why take an opinion on something? It's flawed, and so never do anything about anything. But when you end up in a bubble and things fall apart, then, and if you don't do anything about it, it never really ends well, and everything simply remains on paper. So an active strategy has always been preferred in that sense of about over passive, but you also have to know when to be passive and when to be active. So there are going to be phases, and I think right now we are in one of those phases where liquidity is still driving the theme. You can argue which parts of the market are cheap, but if you simply look at historical P of an index, it will appear expensive, and the point is we've remained at that level as far as Nifty is concerned for almost couple of years now, even though the mid caps have corrected. So will we go to a still elevated level? Then we'll end up looking 10 or more years later than the US very, very similar, because even they went to an elevated level in 2007-8, and there are some people would say even more elevated level now, or gone back to those levels, because some PE ratio charts for the US show that 2000 was the peak, and then 2007 you had a lower ratio, even though the indices were higher, because the markets had not moved that much and earnings were still growing, and so the ratio was lower. And then now in this run up after 2009, you've actually seen the ratios go up much more, and we are now going from the normal elevated level to, if we break out of this range, which is beyond 12,400, eventually you will end up at levels that have not happened since probably 1992, and that would put us in record territory of sorts. So that's what I wanted to highlight, that liquidity has been the main driving factor, and it still is. And at some point of time, that can make it look like there's a rebound. Even though we've seen slow growth, it will look like things are improving for a while at the late stages of a liquidity injection, which is what you're beginning to see in US, not maybe in all parts of the world. But like I said in yesterday's video, you got first set of PMI numbers from Europe and various places again showing that. So which is what ends up happening in financial markets. And then people get overconfident, and then that again peaks out. But we may be early in that all happening all over again. We've been through one round or two rounds of that in the last 6 to 7 years. We may be entering the final round where that happens, and it's probably a blow-off phase. The point is it over or is it not? And that's more relevant from an investing and trading standpoint. That's it. Thank you.